Well, folks, EV mania seems to have come back into the stock market. Nikola Motors, Lordstown, and Faraday Future have all seen their stock valuations gone up significantly over the past week. After the Fed decided to pause interest rates, inflation came down on the CPI, and for the very first time, the S&P 500 entered an official bull market. There's many reasons for why this might be happening, and some are not as obvious as others. Whether it be a lot of short interest, new liquidity entering the stock market, or general value that might be found in some of these beaten down EV startups, there's a lot that we can learn as investors and traders from the moves we witnessed over the past few days. For those that might not be able to tell already, the small cap EV industry is currently in the middle of an epic short squeeze. Shorting Nikola Motors, for example, has become increasingly expensive as shares left to borrow dwindle. This has led to not only the short float of the company coming down from around 30% to 21%, but most option traders have also shifted from being very bearish to bullish, with Nikola's call options trading at the 8th highest volume on the CBOE exchange on Friday. As a matter of fact, on Thursday alone, net retail buying in Nikola stock reached $4 million, which is a record inflow after about 2 years of negligible trading in the equity. This has resulted in the stock putting in its biggest weekly gain since 2020, and although many people would account this simply for a regular short squeeze, this is actually a pretty significant move. And it has all to do, folks, with something called volume. As you can see at the bottom of the chart, this is Nikola's most heavily volume traded week in its 2 to 3 year history. That's right. Even in the debacle of 2020 and the mayhem we've seen throughout the past 12 months, last week was the highest amount of Nikola shares traded ever by a pretty significant margin. And this is the same case for stocks like Lordstown Motors and Faraday Future, which also got caught up in the EV sell-off frenzy of yesteryear. And as is very well known in the industry, high volume tends to precede price action. Although it's very difficult to tell why so much volume and shares have traded hands in something like Nikola, the obvious answer lies between two parties. And those two pillars are either institutional inflection, which typically coincides with a trend change, or shorts covering and taking profits on their position. And right now, data is showing us that it is a mix of both scenarios. Not only have these names experienced extremely high short float as a percentage of their shares outstanding, but overall liquidity in the stock market is increasing at a record pace. Looking at the HLW Real Fed Funds Index, we are at levels we have never seen in the past 35 years. Not only is the G10 excess liquidity starting to tick up in gold, but in the black, we have a lot of room to the upside. And if you look at the previous cycles that we saw this recovery in the black line, it typically always coincided with market bottoms and inherent bull markets. And as we all know, small cap stocks that are unprofitable, like those in the EV sector, tend to be the last to recover in a bear market. And as for why would that be the case, the answer is extremely simple. Electric vehicle startups are considered the most riskiest investments in the small cap space from a liquidity standpoint. The risk of default and bankruptcy is undoubtedly the highest because you're investing a lot of money up front and there is very little chance you're going to get that money returned in a matter of 3 to 5 years, as it takes a long time for companies to attain gross margin profitability. And as you can see, because this excess liquidity inflection is coinciding with small caps underperforming at the lowest level since 2003, you are getting this nice recipe of upside for some of those companies that might be executing well but have seen their share prices decline excessively. And believe it or not, EVs are right now the top growth opportunity for clean technologies, not only in terms of the revenue that it can generate for the companies that participate in the industry, but also for the amount of jobs and US exports it can generate for the economy. It leads clean steel, low carbon hydrogen, and direct air capture. And the reality is, this EV industry is not just going to be dominated by one company. And that fact is something markets are going to start to realize sooner rather than later, especially as we're expected to see more monetary loosening from the government going into 2025. Tesla, for example, has been the prime example of what a purpose-built startup can achieve with its annual revenue hitting $82 billion. In comparison, all the other startups that are currently publicly traded like Rivian, Lucid, Workhorse, Lordstown, and Nikola combined only do around $2.3 billion. And although leadership, innovation, and technology could be attributed to this stark difference, this also has a big thing to do with the timeline of production of each one of these companies. Not only are these startups facing the most difficult economic situation we've faced in more than 20 years, but they're doing this in a time of high interest rates and more competition in the EV sector than ever before. And this is naturally going to lead to more speculation about their downfalls in the short term, which obviously tends to lead stock prices also faltering. And unsurprisingly, this has resulted in EVs being the top most shorted stocks on the Nasdaq and the NYSE. However, as we're clearly seeing over the past week, high short interest can also be a sign of contrarian opportunity. And for me, Nikola is one of the prime examples of such an opportunity. At one point over the drawdown in 2023, Nikola's market cap was less than $400 million. However, the book value per share of Nikola as a company remained unchanged at around $1.20 because their Coolidge, Arizona facility itself is worth around $600 to $800 million, and their total assets on the balance sheet sit around $1.1 billion. And when you subtract liabilities from assets, you get something called the shareholders' equity, which itself was sitting at $545 million. And that right there is a sign that the worst was being priced in by public markets when it comes to Nikola and other similar EV companies. Whether it be short sellers, institutional hedging, or long-term investors getting shaken out, a lot of this tends to be planned ahead of time. Even something like falling below $1 is a scare tactic used to typically iron out retail investors, because typically the Nasdaq gives you 2 180-day periods to regain compliance in case your share price falls below $1. And many companies have options like reverse splits and obviously just using the share price as a tool through marketing campaigns to bring it up to the required threshold. And although liquidity certainly tends to be a problem for such EV startups, there are ways they can turn themselves around, whether that be through a direct offering, institutional buyers, or in some cases issuing stock during rallies like we're experiencing today. Many EV startups are not going to survive, but those that are trying to target a specific niche with a good plan and active progress have a very good chance of succeeding in the long term if the macroeconomic situations start to improve once more. And as for whether or not this EV rally will last going into July, chances are it will because of the strength we're seeing in the small cap IWM index, which saw its best week since 2021. As usual, folks, nothing is guaranteed in the market, and in the short term, anything can really happen with most stocks. So make sure to do your own research before investing or trading any specific equity. As usual, folks, let me know your thoughts on the situation down in the comment section below, and I'll catch you guys in the next one. Take care.